our friends from the media. Before we begin today's press conference, allow me to introduce the panelists seated in front. At the head table, we have Mr. Ashok Ramamurthy, Group Managing Director, AMMB Holdings Berhad. To Mr. Ashok's left, we have Yang Berbahagia Datuk Muhammad Azmi Mahmud, Deputy Group Managing Director, AMMB Holdings Berhad. To Mr. Ashok's right, we have Ms. Mandy Simpson, Chief Financial Officer, AMMB Holdings Berhad. And to Dr. Azmi's left, we have Mr. Ganesh Kumar Nadaraja, Group General Manager, Group Investor Relations and Planning, AMMB Holdings Berhad. And now I'd like to invite Mr. Ashok Ramamurthy, our Group MD, to start the session with a brief presentation.
Thank you. Welcome everyone. If I go through the key highlights for the financial year 2013, this represents our 6th consecutive year of record profit performance where we've met our financial aspirations. Our profits were up 10.2% with positive momentum across a number of the divisions. We've had an increase in our return on equity to 14% this year, and we've held on to a dividend payout ratio of 40 to 50% this year, paying out 41% of our earnings as dividends. Our diversification agenda is on track. We've grown our CASA very well this year. Our CASA composition now is at 20%, compared with an industry average of around 25%. 5 years ago, we were at around 10%. So we have come a long way from having a less than ideal composition of CASA in our portfolio of deposits. Our loan deposit ratio is in line with our strategic aspirations of 90% plus or minus 2%, and we continue to diversify our funding base. Our loans portfolio rebalancing between retail and non-retail continues. We ended the year with a further improvement in the quantum of non-retail loans in our portfolio, and within retail towards the right segments. And we believe we are optimally positioned for Basel III around capital. There is more work required as we need to fathom the financial services holding company requirements which Bank Negara will put out over time. We believe we've got clear strategic priorities that we initiated last year, and we are tracking well against those. And the 2 acquisitions we have done, which is Kurnia and MBF Cards, are on track in terms of integrations and the synergies that they will deliver to us. And in terms of AmLife and Antakaful, we are in the throes of exploring a strategic partnership. We have real interest from very good partners globally, and as we complete, we hope to complete that during the course of the first quarter this year. And so if you take a look at the different financial and non-financial metrics, we've continued to grow our profits and our earnings per share, our return on equity and return on assets over the last 5 to 6 years. We believe we're delivering an optimal mix of returns to our shareholders, continuing to grow our franchise in terms of net lending, customer deposits, the composition of CASA within that, and doing it in a sustainable way in terms of having the right loan deposit ratios for us that we continue to maintain at 90% plus or minus 2%, with, we believe, an improving risk profile. Our net impact loan ratios continue to come down. We've had an uptick in cost income ratio this year, a function of the fact that we've made some acquisitions and invested in the business. Our capital, as I said, is optimally positioned for Basel III, both in terms of the common equity ratios as well as in terms of total capital. So if we then take a look at the scorecard that we normally put out at the beginning of the year and see how we are tracking against that scorecard, the profit growth, return on equity, impaired loans and dividend payouts are all ticks. In terms of the cost income ratio, we have slipped from where we expected to be, partly as a result of acquisition and partly as a result of some of the investments that we've continued to make for medium-term returns for the business. This is one that we'll continue to focus on to ensure that we can continue to save in business as usual activities to fund our reinvestment activities and for revenue growth opportunities over time. So in terms of the acquisitions, the synergies are generally on track. We know the one that will typically take us the longest is the systems integration, which in this case is no different. Those acquisitions will help us continue to grow our non-interest income, which is a key strategic plank for us. It strengthened our market positioning both in cards, merchants, as well as in the general insurance side, our motor insurance and other businesses within that portfolio. We've achieved some cost synergies in the first year. There's further work underway to get more in the next year or so. And AmLife, as I said, we are exploring our strategic options. On that note, I was just going to hand it across to Mandy, who will take you through the financials.
Thank you, Ashok. Good afternoon, everyone. So firstly, looking at our contribution at a broader grouped up level for the entities that make up the AmBank Group, and you'll see that the commercial banking activities have driven the growth this year, along with the acquisitions driving some growth there in the general insurance business, which were both very strong. While we had a slightly more subdued performance in our investment banking division, which is our IB and markets business, and the life assurance business and Takaful, which is in startup phase for the Takaful piece there. So now if we just take a more detailed look at the financials, at the profit numbers, you'll see that net interest income and lower allowances underpinned our full year results this year. If we look at the net interest income, it was up a very solid 4.5%, which reflected some very strong loans volume growth in our retail, business bank and corporate businesses, though was slightly offset by some margin compression there. Non-interest income was weaker, driven predominantly by the IB and markets business, though there was some good growth in fee income as a result of the lending activities, along with some growth from the merchants businesses as well, resulting in overall income being up just under 2%. Expenses ticked up this year, driven predominantly by the acquisition costs, which was the one-offs that we've taken as part of the 2 acquisitions that we undertook, and some costs associated with those to extract the synergies out. We also continue to invest in our infrastructure and our business to get growth going forward. The provisions and allowances were down as the asset quality of the book continued to improve, which overall resulted in our profit being up 10%. Before one-offs. If we take out the one-offs from the acquisitions, then the profit was up just under 12%. Now if we look at the growth by each of the divisions, you'll see there that the activities from our retail business and corporate bank, which were driven by lending activities, all saw very strong results with some good volume growth there in retail, along with the banker distribution, which is the distribution of our life assurance products. Business bank, higher income with some good loans and deposits growth there, and some very strong income performance from our CIB business. As I mentioned, slightly more subdued performance in investment banking and markets, partly driven by the volatility in the market and no major larger primary issuance deals for us. General insurance business growth, which now makes up 10% pre-minority interest for us as part of the overall contribution to the group's profits, was driven by some improved underwriting margins and improvement in our claims management experience. It also includes 6 months from the Kurnia acquisition in those profit numbers. Life assurance, previously we just took one net line through for the life assurance business. Under the new Bank Negara reporting guidelines, we do fully consolidate that now, which means that we do take into account, take the hit for any movements in the contract liabilities or the actuarial assumptions as part of those, which has driven the impact there year on year. Our transaction banking and Islamic businesses, their profits are included in the broader divisions, but we do call that out so that you can see independently how those businesses performed. You'll see some very strong growth there from transaction banking. We've rolled out some broader technology platforms there, and we've got a full suite of cash management products now, and there was some very strong CASA growth there, so that's our low cost deposits being up just over 60%. The Islamic business growth was driven by very strong growth in the auto finance business. Now just taking a look at loans growth, you see overall loans growth at 9% was just under industry growth of 10%. We continued to grow faster in the non-retail areas, so the business bank and corporate lending was up 13% versus industry for that segment of around 11%, and retail had the strongest quarter that we've had for some quarters, was up 6%. This is part of us continuing to want to rebalance the portfolio closer to the industry average of 50-50, and now non-retail makes up 42% for us, so up 1% from the previous year. Now just taking a look at asset quality, you'll see that our asset quality continues to improve with gross impaired loans down 45 basis points for the year and our credit cost now at an all-time low of 21 basis points. Our loan loss coverage, which is the amount of coverage we have for if any of our loans get impaired, is now at 129%, which is well above the industry average, and so we're very well covered there if anything gets impaired. As I mentioned, we had very strong deposit growth, and we'll now see our CASA composition making up 20% of our overall deposits, which is a stark improvement from the 11% we had 5 years ago. And our liquidity remains healthy as we continue to build a diverse source of funding there. At the start of this calendar year, so 1 January, we adopted Basel III at a banking entity level, and you'll see there that we're still well positioned for our targeted dividend payout ratio. So we've increased that to just under 41%, which equates to earnings per share of 54.5 cents for the year. I'll pass back to Ashok.
Thanks, Brandy. I mean, in terms of outlook for the current financial year, which began for us a month and a half ago, we believe the economic activity in Malaysia is likely to remain stable. Previously, in this pack, we've got a growth in GDP of around 5.3%, which was done just before we saw the first quarter numbers, which came in at lower than most people's expectations. But now that the uncertainty of elections is done and dusted, we expect the economic activity to normalize and start picking up from here. Generally speaking, the ETP initiatives will be the primary driver of that growth in Malaysia. We know the external demand will continue to be patchy in different parts of the world. The policies we expect will continue to be accommodative from a Bank Negara standpoint. The risks from the rising household debt appears to be contained, is one to continue to watch out for, and take lead from how Bank Negara would lead that part of the loan story. In terms of banking, I think the large part of our growth will continue to be banking the economic activity in Malaysia, which I said again is built around the ETP. The new responsible lending guidelines and the regulatory reforms will continue to put pressure on loans growth in the consumer side. Having said that, in the first quarter, that appeared to be quite sound. The price-based competition that we've seen in the last couple of years is one that we expect to moderate this year. The margin pressures might not be as severe as what we've seen in the last 2 years. Having said that, we're seeing some pressures emerge in new segments which weren't there before, which is the top end in town. The margins still appear to be hotly competed on. And that might mean that the pressure on margins is not likely to be as steep as what we've seen in the last 2 years in a mixed FX sense. Our asset quality trends, which we believe has been very good, is particularly from a provisioning charge perspective, is at a low point. We're expecting our recoveries that we've had, healthy ones coming in the last couple of years, are likely to decline going forward, and that means a small increase in provisions to be expected in the next year or two. So what are our strategic priorities, given that market context? We need to integrate the 2 acquisitions we've done, integrate them well, and deliver the synergies that we believe are available to be had. The second one is that we need to simplify our business model to ensure that we keep our customer in our line of sight and streamline some of the internal processes we've got to serve our customers. As we do that, we expect to generate some savings, which we would hope to reinvest back into the business for medium-term growth in incomes. In particular, around organic growth, our focus is around increasing our cross-sell to our customers, ensuring we do more of the flow business, trade, cash, focus more around developing the right propositions that will enable us to bank small businesses in greater numbers than what we've done in the recent past, and then target more of the emerging affluent customers within retail. In our specialist businesses like life insurance and general insurance, we'd like to build scale, working closely with our partners. And lastly, we would need to continue to optimize the capital and holding company structures as we learn to understand how to deal with the new Basel III Bank Negara environment. So overall, what does it mean in terms of key performance indicators? Going forward, we believe we can sustainably achieve a growth of around 10 to 12% for the financial year 2014, with rising ROEs from 14% towards the 14.5% mark. We might end up somewhere within that range, with a small improvement in our efficiency ratio, maintaining our gross impaired loans at around current levels, and then maintaining our dividend payout ratios around the 40 to 50% level. As we complete the integrations, we hope that that'll add to our bottom line, and we can deliver faster growth in the outlying years of 15 and 16. So in summary, the key takeaways for the year that's just been completed for us is that we've delivered a 6th consecutive year of record profit performance. We've had consistent growth in returns. We believe we've optimally balanced that through that period. Our diversification agenda around retail, non-retail, fixed loan, variable loans, Islamic, conventional still continue for us. And we're adding more to our portfolio through some of the investments that we made in the recent past. We've got clear strategic priorities for us to execute to. And lastly, our acquisition synergies are on track as of today. That's about the formal part of the presentation. As usual, we'd be happy to take any questions.